All right, let's talk investing. Today, we're cracking open the investor's playbook. If you've ever felt like the stock market has its own secret language, well, you're not wrong. But don't worry. By the end of this, you're going to understand three of the biggest plays in the entire game: growth, value, and dividend investing.
But before we dive in, let's start with a question for you. What's your financial game plan? Because here's the thing, successful investing isn't about finding some single magic formula. It's about figuring out the options and then picking the strategy that actually fits your life, your goals, and hey, how much risk you're really comfortable taking on. So let's meet our first investor type. I like to call this one the sprinter. As you can probably guess, this strategy is all about speed, all about potential, and really, it's about making a bet on the future. It's for people who are looking for some seriously rapid expansion.
So what exactly is a growth stock? Well, put simply, it's a piece of a company that everyone expects to grow way, way faster than the average company out there. Just picture a young, super innovative tech startup or maybe a biotech company that's right on the edge of a major breakthrough. These companies are in an all-out race to get bigger and fast. And as an investor, you're basically betting that they're going to win.
You'll notice growth companies have a pretty distinct DNA. They take just about every dollar of profit they make and pour it right back into the business, for more research, hiring top talent, or a massive marketing push. And that's exactly why they almost never pay dividends. All that cash is needed to fuel the engine. The main goal here is what we call capital appreciation. In plain English, you make money when the stock price itself goes way up. But, and this is a big but, this high-speed race can get pretty bumpy, which is why these stocks are often much more volatile.
This brings us to a really key idea: paying for potential. And we can see this in a metric called the price-to-earnings ratio, or PE. With growth stocks, you're often paying a premium price, that's a high PE, not for what the company is making today, but for what you believe it could make down the road. It's a bet on the future, not the present.
Okay, so that's the sprinter. Now let's completely switch gears and talk about our next profile, the hunter. The hunter isn't chasing speed at all. No, they are patient, they are methodical, and they are looking for a bargain, a hidden gem that the rest of the market has somehow overlooked. At its heart, a value stock is a share in a company that, for whatever reason, just seems like it's on sale. You look at its fundamental strength, its profits, its assets, its position in the market, and the stock price just feels lower than it should be. The value investor's whole job is to find these discounted treasures.
So, the hunter's mindset, it's pretty much the polar opposite of the sprinter's. They're actively looking for stocks with a low PE ratio. They're searching for established companies with really solid, strong fundamentals that maybe just hit a temporary rough patch or are simply out of fashion for the moment. The entire strategy hinges on one belief: that eventually the market will come to its senses and the stock price will rise to reflect its true value. As you can imagine, this is not a get-rich-quick scheme. It takes a ton of research and a whole lot of patience.
And that brings us to our third and final profile, the earner. This investor's playbook isn't really focused on the thrill of the chase or the sprint to the finish line. Nope. The earner prioritizes a steady, predictable stream of income above all else.
A dividend stock is a share in a company that literally pays you to own it. It's that simple. These are usually mature, very profitable companies with such stable and predictable cash flow that they can afford to share a slice of the profits directly with you, their shareholder, usually every single quarter. Think of it like owning a well-established orchard. You're not hoping it grows into a forest. You're just happy to get a reliable harvest of fruit season after season.
All of their key characteristics really scream one word: stability. We're often talking about those big, blue-chip household names. They aren't necessarily expanding at lightning speed anymore, but boy, are they reliable cash machines. For investors who need regular income, maybe you're in or near retirement, this is incredibly appealing. So what's the trade-off? Well, their potential for that explosive sky-high growth is often a lot lower than a growth stock.
Okay, so we've met the whole crew: the sprinter, the hunter, and the earner. Three totally distinct players with three very different game plans. So now for the big question: how do you figure out which playbook is the right one for you?
Let's just put it all side by side. It really makes things clear. First, look at the primary goals. The sprinter just wants that stock price to soar. The hunter wants to buy low and then patiently wait for the market to correct the price. The earner, they just want that regular paycheck coming in. And this naturally leads to the kind of person who fits each style. If you can stomach big swings and have a long time to invest, you might be a sprinter. If you genuinely love digging into company reports and have the patience of a saint, you might be a hunter. And if you prioritize those predictable payouts over everything else, you just might be an earner.
So what's the ultimate takeaway here? There's no trophy for picking the best strategy, mainly because a single best one doesn't exist. The only thing that truly matters is picking the strategy that is best for you. It's a deeply personal decision based on where you are in life and where you're trying to go. And hey, you can even mix and match. You can build a whole portfolio team with sprinters, hunters, and earners all playing together.
And that leaves us with one final thought to chew on. The strategy that works perfectly for you today might not be the one you need in 10 or even 20 years. Life changes. Our financial goals definitely change too. So the real question isn't just about which playbook you choose right now. It's whether your playbook is ready to adapt and evolve right along with you.